Good afternoon, everyone, and welcome to the next webinar in the Gain.pro series. As expected, today's topic is super hot, so things have taken a little bit longer for everyone to get in, but I think we're pretty much good to go now. So thank you for joining us. My name is Chrissy Jameson. I'm the VP of Marketing for Gain.pro, and I'll be looking after you all today. We just have a couple of housekeeping things before we get things kicked off. Firstly, this webinar is being recorded and it will be sent to you early next week. You'll also be able to find it in our monthly newsletter and also on demand on our website too. Secondly, please do feel free to share it within your organisation with anyone you think it might be useful to. Please do let us know if there are others that may like invitations to these events, as we have follow-ups coming in the coming months as well. So without further ado, I'd like to introduce our speaker for today, who is well known to many of you, Frista Havman. Frista founded Gain.pro back in 2018, and today he leads the company as CEO with a mission to build the business into a global market leader. Prior to Gain.pro, Frista spent his career in consulting and private equity with companies like Bain, Gilder and Bridgepoint, and he combines this experience with a deep, deep passion for technology. So welcome, Frista. I'm super excited to get stuck into this data, as I'm sure everyone else is. So I'll pass over to you now. You're on mute.
Yeah, thank you very much, Chrissy, and thank you very much for joining. This is a really exciting one. We've actually been meeting many of you live over the last couple of weeks when we were talking about ChatGPT and generative AI, and that was something that really hit us in December, and then we wanted to be there with you to discuss this really new topic. This is actually something that has been building in the background for a much longer time, and it's about the ability as a private equity investor today to still find growth opportunities in the European continent, and it's a topic we've been spending a lot of time on, a lot of data analytics on. Yeah, quite keen to dive into that today with all of you. So without further ado, what are we going to do today? We're going to start by discussing the topic of growth in Europe. First of all, why do we need growth as private equity investors? Is there still growth out there in our continent? And who are leading the way in capturing that growth? So that sets the stage. And then we're going to go into the two avenues to capture growth, one being organic growth. So where are the pockets of growth today? The topic of means that can be deceiving, so the level of granularity needed to find growth companies, and then also the trade-offs that are required if you want to invest in growing assets. And lastly, also the path for buy and build, so the non-organic growth path, acquisitive upside, where are the fragmented markets that you can step into today, as well as what are the uncharted territories, so the areas that have not been invested deeply by your peers. And then lastly, we'll end with some investor takeaways on the basis of all this data. So let's step into the first part, growth in Europe. Why do we need growth? There still is growth, and who are the growth leaders? Taking one really big step back, what we've seen is that private equity returns have historically been driven largely, and actually increasingly so, by multiple expansion, EBITDA margin expansion and revenue growth, and especially multiple expansion. 60% almost of today's returns are from multiple expansion, which makes people worry quite a bit today. If you think of a challenging monetary climate, and for that reason, contracting valuations, how are you ever going to make money in such a market environment? And I think that's top of mind with many investors today. And we want to take a slightly nuanced view there, because here we have those three drivers you always see: multiple expansion, EBITDA margin expansion, revenue growth. But we actually dove into the underlying drivers of creating value from these levers. So what you see here now on the top end are again those three levers, and we actually added leverage to them. But on the left hand side, you see the underlying drivers that actually drive the returns from those drivers. So you have organic growth driving revenue growth through top line expansion and through creating operating leverage. So in a way, also driving EBITDA margin expansion. You have buy and build, which leads to inorganic acquisitive revenue growth. You have buy and build also leading to cost synergies, hence to EBITDA margin expansion. And lastly, buy and build can lead to multiple arbitrage because small assets trade for a lower multiple than large assets. Next, you have operational improvement, which you can still do. You can drive cost improvements and you can enhance the profile of a business, and in the end leading to multiple expansion. And then lastly, you have the financing environment. And this is, of course, where that pressure sits. So we mark them out as challenged by the current monetary environment. So the market multiples are coming down. Leverage ratios make leverage less of an interesting driver. But if you look at the column of multiple expansion, what you see is that even when monetary challenges make it much more difficult to realize that market multiple generic uplift, you can actually still benefit from multiple arbitrage through buy and build. So the small versus large arbitrage is still open, as well as profile enhancement. So even though multiple expansion is severely challenged by the monetary climate, multiple expansion growth is still possible, also in the climate that is there today. I think that's an important insight to mention. So, but overall, we know that market multiple uplift that was there in the last 10 years is not going to be there necessarily in the next 5 to 10 years. So the focus will shift to those other blocks, so to the organic growth, the buy and build, and the operational improvements. And this document is going especially into the first two, organic growth and buy and build, less so into operational improvements. Now, when you start with the top line and with the organic growth, the other challenge is, of course, the monetary, or basically the macroeconomic climate. If you look at the European Union as an economic zone, it's underperforming severely relative to China and to the United States as well, and indeed to the world in general. So of the three economic blocks in the European Union and also in the UK, we're being macro challenged as a sector. If you're looking for growth, and growth is needed to generate attractive LBO returns. Now, you also see that in the whole world, growth is coming down. So it is not just a European problem. We're talking about Europe today. Now, that may sound quite depressing, but actually when we dove into the data, even though that was the overall macro picture, if you look at the pool of companies, and then we're not talking about a biased pool, but basically a pool of all companies out there in Europe of some size, so basically using our own database, we did find that most assets on average are able, so in the median, generate these types of year-on-year growth percentages. So besides 2020, which is the COVID year, you saw percentages in the high teens of overall median growth. And actually then in 2021, you saw this huge uptick post-COVID, basically the post-COVID recovery together, averaging out at those prior percentages. So, and that is in that low growth economic period. And that presents a little bit of a dichotomy. We'll dive into it. It has to do with the fact that this is overall growth and not only organic growth. And the second part is also that there's in a way a bias in the pool of assets out there towards assets that don't go bankrupt. So there's a way of then tying together these figures with the overall GDP climate. But it's quite interesting to know that the asset pool out there actually still has plenty of growth assets also in a macro challenged environment. Now, what's even more interesting perhaps is that if we dive into ownership data, you see that private equity backed companies are able to grow at a rate twice as high as privately owned companies. And this is the median overall revenue growth CAGR of companies. So you see private ownership on average almost 5%, private equity backed well above 10%. So that's quite positive. Private equity firms are indeed able to capture growth disproportionately 2 to 4 times the rate if you also look at venture backed and minority PE backed, which do even better as the average fully privately owned business out there. Now, and what part of the explanation there is M&A, is buy and build. If you look at, and this, I appreciate this is a relatively complex slide, so I'm going to explain it one step at a time. On the x-axis, we find 10 buckets in which we included all companies out there based on their total revenue growth rate. So going from less than 0% all the way to above 15% growth. And then we allocated all the companies to one of these buckets. So the percentages add up to 100%. And we did this for both organic revenue growth, which is in light blue. And so for tens of thousands of companies, we've analyzed the organic revenue growth, and this is the aggregate output. And we also did this for total revenue growth. What you then see, you can compare the medians of those two. So the median organic growth rate sits at roughly 4 to 6%, whereas the median overall growth rate sits at 8 to 10%. So on average, companies are able to roughly double their growth rate through M&A. Now, that's not fully equally divided. You actually see that a very large part of the private companies, so here we have two charts. On the left-hand side, we see all private companies. On the right-hand side, we see all private equity-backed companies. You see that over half of the private companies never do any acquisitions, and also many do non-meaningful acquisitions. And actually, there's very few private companies that are having a very strong M&A record of either clear volume of buy and build transactions, or even continuous buy and build transactions. If you look at the private equity landscape, that's very different. Most of them do M&A, and a really good number actually do this on a continuous basis. So private equity backed is capturing a really large part of growth through that increased level of buy and build activity. Now, then we get to this bubble chart. What we're showing here is kind of a combination of what we showed in the prior two analyses. So we talked about buy and build, and we talked about organic growth. And what we did is for every private equity company, and to be more specifically for every private equity strategy, we analyzed for their full portfolio the approximate organic growth rate on the level of every individual portfolio company, and then we aggregated that on the strategy level. And we did the same for their level of buy and build. So we analyzed roughly 15,000 companies that together are summarized on this slide. So on the x-axis, we show that average organic growth rate for all the portfolio companies in that strategy's portfolio. And on the y-axis, you find the average buy and build activity, ranging from no acquisitions at all to continuous acquisitions. Now, you see that there's a vast difference in private equity's preference for organic growth, because at the end of the day, this is, of course, a preference to pay up. And also their willingness and ability to be very active in buy and build. Now, and by the way, the bubble size here represents the median asset size. So a large bubble presents investors that invest in very large assets, and small bubbles are small cap or mid cap investors. Now, of course, being in the top right does not necessarily mean that these are better investors. You might as well be a restructuring focused investor being in the bottom left and do very well. So there's no right or wrong relative to where you are on this slide. Having said that, we actually looked up the top 10 best performing funds according to the AGC ranking, and we did that for Europe. And if you look at those, you actually see that they are virtually all in the top right. So at least in the last decade, being an organic growth focused with an investor with additional buy and build capabilities has been paying off tremendously. So it absolutely is not said that you have to be a growth investor or an active buy and build investor to be successful, but it definitely has helped a lot of the investors that have been deploying this strategy today. And I think this is a very interesting insight. So that is on the investors. And basically, we've now talked about why we need growth. Well, we need it to make our LBOs work, and it's hard to find today. But actually, if you look better, there still is growth. And we've looked at those leaders that are kind of leading the way in capturing growth. But then looking at the asset pool, first of all, what are the growth opportunities out there? So how are we going to capture organic growth? So we're going to look at where are the pockets of growth. We're going to look at a topic of means that can be deceiving, and we'll talk about that in a little while more. And we'll talk about trade-offs. Now, let's start with the first, pockets of growth. So what we see here is we ranked all the sectors out there by their average organic growth rating. And then on the y-axis, we also brought a slightly a slight bit more nuance of the level of cyclicality on average of the assets that represent those sectors. So we maybe unsurprisingly see TMT as fastest growing and industrials as slowest growing. And then we go one level deeper. So instead of looking at TMT, we're looking at underlying sectors and so forth. So here we map roughly 30 subsectors. And we see that the likes of biotech, software, asset management stand out in growth. Quite unsurprisingly, automotive, manufacturing, chemicals are underperforming, and leisure as well in the last couple of years. But then we go one level deeper, and this is where, in a way, the data becomes difficult to present on the slide, but even more applicable when you get into the data set and try to operationalize this data. So here we look for roughly 200 sectors at the same criteria. So you still see the legend of consumer, financial services, etc. But then you really go one level deeper, and what you then start to see is that even within those industries, the averages widely vary if you dive one level deeper. So you have parts of TMT that are actually very slow growing, and you have parts of industrials that are doing fantastically well. So here you get to a much more interesting level of depth. And you see in the top right, for instance, the likes of telemedicine and EV charging, which no one will surprise. And on the bottom left, machine tool manufacturing and everything in between. So that's the kind of granularity that we're now dealing with. One thing to note there, here as you can see, we swapped the y-axis. So here we looked at the level of cyclicality. And here we replace cyclicality by EBITDA margin. And what you then see is that the likes of EV charging and shared mobility grow very fast, but their levels of margins in those industries are actually quite a bit lower still. So of course, and you see it's not a perfect correlation, but there's a slightly negative correlation between profit margin and growth. So of course, one would have to weigh those two against one another when picking sectors here to dive into further. And that brings us to another point of the means and how means can be deceiving. I think, first of all, what an insight here, if you think about it. So you're talking about the European economy, which is a low growth economy. If you look at the sheer diversity of growth rates that represent the economy, if you dive one level deeper. Now, even this is still a complete simplification, because within all of these sectors, you will find the same dispersions. If you zoom in on any of these sectors, you'll find that it breaks out into some really fast-growing companies in slow-growing sectors, as well as some really slow-growing companies in fast-growing sectors like software. And if you actually look at it, you see that the four sectors that represent above average growth, which are services, science and health, financial services, which in our database are mostly financial services, EBITDA-based businesses and TMT, they represent a large part of the overall set of growing companies, but not every fast-growing company is within those fast-growing sectors. So in fact, the slow growth sectors of industrials, materials and energy and consumer together represent a good 1/3 of all the companies out there that grow above 15% organically. So growth investing is not only about being a software investor. In fact, it might pay a lot better to be more granular in examining these maybe slightly less high multiple sectors for the most pertinent organic growth opportunities. The other thing to be aware of is that, of course, it's very nice to hunt after fast organic growth companies that will present a much higher EBITDA margin upon exit and entry, but it comes at a cost, and they're very rare. If you actually look, and what you see here on this axis is, again, we have those 10 buckets of organic revenue growth that we've put every company in, from negative growth on the left-hand side to above 15% organic growth on the right-hand side. And then we check how many of the companies are in those buckets. You see, of course, every company, and this is a threshold, so every company makes it above negative growth. But then only 70% of the companies are above 3 to 4% organic growth, and so forth and so forth. If you look, actually only 24% companies manage to grow faster than 15% organically in our data set. And actually, and here is where the trade-offs come in. If you're then also saying they need to be very profitable, even if you only put the cutoff at 12% EBITDA margin, there's only 7% of the companies out there that are combining 15% organic growth with also being above 12% EBITDA margin. And actually, if you want to look for 20% EBITDA margin, it drops to 4%. So 15% growth, 20% EBITDA margin exclude 96% of the companies out there. And if you put some additional analyses on top, like other investment criteria, for instance, the level of resilience or cash conversion, you very quickly see that you will almost always have to make some trade-off somewhere in order to find an asset. If you're looking for a fast-growing company with high margins, high cash conversion, an international profile, and good resilience, you're basically very quickly dropping down to 0.01% of the companies out there. So every investor needs to know where their trade-off is and where they're willing to make those trade-offs. So now we've talked about growth in Europe. We've talked about capturing organic growth and the asset pool out there. And then the last part is the path for buy and build. So we're going to talk about acquisitive upside. So why is it interesting to do buy and build? What markets are still out there that are fragmented that present opportunities, and where have other PEs gone less so? Starting with the first. So why would you do buy and build? I think the most obvious one is the one we mentioned, the small versus large multiple arbitrage. A small company sells for a lower multiple than large companies. If you combine a couple of small companies, you generate a multiple uplift. But there's another effect as well. We actually looked at data for the last 5 years. And what we saw is that companies that do continuous acquisitions were able in the last 5 years to improve their EBITDA margins by 2.4% on average, whereas companies that did no acquisitions at all still improved their margins, because on average companies improved their margin in the last 5 years, but they actually only got to 0.9%. So despite all the complexity of integrating multiple businesses, these companies were able to generate real synergies. And that was maybe a little bit of a surprising insight to me, because I often thought that synergies were quite hard to realize, easy on paper, hard in practice. But if you look at the data, you see that actually companies are able to realize them. So synergies from M&A are real. And we actually checked if this might be a spurious correlation thing, for instance, with the level of growth of the companies out there, and sort of only companies with improving margins doing more acquisitions, or only companies that are growing nicely doing more acquisitions. But actually it held. It also held across ownership categories. We'll go into that in a bit more detail in our accompanying report. But this insight kind of holds also when you pressure test it. So you want to do buy and build because you have this small versus large multiple arbitrage, and you want to do buy and build because it improves your margins. But where do you then do buy and build? Well, you do that in fragmented markets, and the HHI index is an index that kind of measures the degree of dominance of various market players within an industry. And if you map out the key sectors, financial services is the most concentrated, whereas professional service, for instance, is the least concentrated. So this is the highest level to look at this data. It's not the most useful level. Again, you need to go granular. Now we immediately go very granular here, 200 sectors, and we mapped on the x-axis their overall organic growth rate, so the average organic growth rate within that sector, and on the y-axis that HHI index, so the level of concentration within those markets. So you see, for instance, that the market like drug manufacturing is highly concentrated. A market like shared mobility is actually sort of medium concentrated with high organic growth. So you can see in this market, if you would dive into the data, you can find exactly those markets that present interesting buy and build opportunities. And there's, of course, also a way to weigh this against their profitability level. So you kind of get to a 3-axis model. The other way to look at this is to see the percentage of private equity owned companies. So in other words, what are the uncharted territories versus where have your peers gone mostly into already? So this maps the percentage of private equity owned companies on the x-axis versus the average number of companies that are added onto a platform deal. So you see most, and what you see is a very strong correlation here between the level of private equity in a sector and the level of add-ons being conducted. So in services, private equity is actively rolling up the market. In industrials, there's less private equity penetration and also less buy and build activity going on. Now, again, the real beauty is here in going much more niche. The same correlation holds, but becomes much more dispersed. And here you can, for instance, see that there's heavy private equity involvement in business management software and exhibition management. In business management software, they're also doing a lot of buy and build. Whereas if you look at the bottom left, you actually see that people that cultivate tomatoes is a market where there's hardly any private equity today, and also hardly any add-ons. And then you can weigh it again against profitability and other metrics, growth, to see where the interesting pockets are for buy and build. So we've talked about growth in Europe, we've talked about capturing organic growth, and we've talked about paths for buy and build. Then we'll now summarize that in some takeaways that we believe this data has shown us. First of all, we discussed the point that multiple expansion is under pressure from the overall monetary climate, but that it's not entirely that. So again, repeating the same point, the overall market multiple may turn negative. That doesn't mean you can't still create multiple arbitrage from buy and build. It also means that you can still clean up an asset, divest non-core, for instance, lower client concentration and increase the rating of an asset on the basis of a better profile. So there's still ways to also realize multiple expansion, even in the current economic climate. That's one takeaway. The second takeaway is there are growth opportunities also in a low growth macro climate. The granularity of growth and the dispersion of growth around the mean is such. So within sectors, within subsectors, within niche industries, within those subsectors, and then even within the niche industries themselves, just the dispersion of companies out there, there are so many companies that are growing very nicely in the European economy, and it's our job to find them as investors. And if you align them to them, you can still align yourself to a lot of growth organically and buy and build led, even in the current climate. I think that's the second takeaway. The third is maybe, again, this point of dispersion. So it's one thing to all run after the hottest software assets that we all know are growing very fast, but it's perhaps much more interesting to pick the winners within their markets. If you only hunt after the fastest on average growing sectors, you're missing out on many growth opportunities, and those growth opportunities might actually come at a more attractive valuation rating. So pick winners within their markets rather than just hunting after winning markets in general. And the fourth kind of follows from the third. If you want to do that, you need to leverage the granular data there is today on tracking these businesses at a level that goes much deeper than sector X is growing nicely. So we're going to dive into that. So get really granular, both on the sector and subsector level, and on tracking individual companies, which today you can, to counter the monetary headwinds of the overall multiple contraction. So those are some takeaways that we found on the basis of this study. Now, what's next? We've come to the end of this session, but this is only the start of our work on organic growth and buy and build growth in Europe. The slides we just showed are roughly representing 1/3 of the slides that we're putting into the report Growth in Europe that will release probably roughly by the end of this month. So really stay tuned for that. This is only a teaser of that data, and we'll dive into a lot more analysis in the report Growth in Europe to come. And second of all, what you can see from those many bubble charts is, of course, that they're nice to look at, but the real value is in turning them into action. And for that, you need the data sets. You need to dive into the data sets, and we'll make those data sets available to our clients, actually. So together with the report release, you'll see that come your way if you're leveraging the Gain.pro platform. So that is growth in Europe for today. Stay tuned for the report where you're going to find much more. And then let's get started on working with the data set on unlocking growth opportunities that are out there. For now, thank you for joining. If there are any questions on this presentation or the data that we showed, or anything at all, you can contact Chrissy Jameson, who opened this webinar, or myself. The email addresses are listed over here, and we'll be glad to take on those questions with you. Thank you.